Hey, welcome to The Explainer. Today we're going to unlock one of the most powerful tools in all of business. It's a single document that, believe it or not, can tell you a company's entire financial story.
I mean, seriously, just think about that for a second. What if you could get like a financial x-ray of a company and see exactly where it stands on any given day? Sounds pretty complicated, right? Well, what if I told you it's actually not?
Because you absolutely can. The tool is called a balance sheet. And you should think of it less like a long, complicated movie and more like a photograph, a perfect snapshot of a company's financial health at one single moment in time.
To really get this story, we only need to meet three main characters. It all kind of boils down to what a company owns, what it owes, and what it's ultimately worth. So first up, we've got assets. Look, in simple terms, this is just all the stuff the business owns that has value. We're talking cash in the bank, the buildings it works out of, the equipment on the factory floor. You get the idea. Anything that can provide a future benefit. Next up, liabilities. This is everything the business owes to other people. It could be a loan from the bank, or maybe a bill from a supplier that hasn't been paid yet. These are basically the claims that outsiders have on the company's assets. And that brings us to our third character, owner's equity. This is what's left over for the owners after all the debts are settled. So if you take everything the company owns, all its assets, and subtract everything it owes, all its liabilities, what you're left with is its net worth. That's the owner's true stake in the whole operation. So here's how it all comes together. A balance sheet puts everything a company owns, its assets, on one side. And on the other side, it shows who has a claim to all that stuff. It's either creditors, which are the liabilities, or the owners themselves, which is the equity. Let's take a look at a real-world example here from the Vagabond Travel Agency. Now there's this fundamental law that governs the balance sheet. It's a rule that can never, ever be broken. You can think of it as the engine that keeps the entire financial world in perfect harmony. Seriously, every single transaction, every sale, every payment a business makes, it has to obey this one simple, elegant principle. And here it is, the accounting equation. Assets must equal liabilities plus owner's equity. You know, when you think about it, it just makes sense. Everything a company owns has to be claimed by somebody, either by lenders and suppliers or by the owners. That's why the two sides must always, and I mean always, be in balance. Let's jump back to our Vagabond Travel Agency example. Let's say their total assets add up to $300,000. Well, because of that golden rule we just talked about, the other side of the equation, their liabilities plus their owner's equity, would also have to equal exactly $300,000. It will always balance, right down to the penny. Okay, now for the fun part. Let's see how this equation actually works in the real world by watching a business come to life. We're going to follow the story of a guy named Michael McBrien as he starts his new company, Overnight Auto Service. We'll track every single transaction and see how it hits his company's balance sheet. All right, January 20th. Michael and his family invest $80,000 cash to get this thing off the ground. So the company now has its very first asset, 80 grand in cash. And where did that cash come from? The owners. So owner's equity goes up by the exact same amount. See? Assets equal equity. We are in balance. The very next day, Overnight buys a piece of land for $52,000 paying in cash. Now this is cool, check this out. All this happened here is the assets just changed form, right? Cash went down, but a new asset, land, went up by the same amount. The total value of their assets didn't change one bit, and the right side of the equation is totally untouched. That scale is still perfectly level. Okay, next, the company buys a garage for 36 grand. They pay for part of it with cash, and then they take out a loan for the other 30,000. That loan, that's a liability called a note payable. So watch what happens. The total assets go up by a net of $30,000. And to keep things in balance, the liabilities on the other side, well, they go up by the exact same $30,000. Both sides grew in perfect sync. So now Overnight needs some tools. It buys $13,800 worth of tools on credit. That just means they get the tools today and promise to pay for them later. This adds a tools and equipment asset on the left. And on the right, it creates a new liability called accounts payable, which is just a fancy way of saying they owe money to a supplier. And look at that. The equation is still perfectly balanced. Now Michael realizes he kind of went overboard and bought a few too many tools, so he sells some to another local business. The buyer agrees to pay him in 45 days. This creates a new type of asset called accounts receivable, which is simply the company's right to collect cash that it's owed. Notice here, One asset, tools, went down, while another asset, accounts receivable, went up. The total asset value didn't change at all. A couple days later, that business pays off $600 of its bill. So watch the balance sheet. The accounts receivable asset goes down, while the cash asset goes up by the exact same amount. All that happened is the company turned a promise of payment into actual money in the bank. Total value of assets? Unchanged.
All right, now it's time for Overnight to pay some of its own bills. It pays off $6,800 of the money it owed for those tools. This is actually the first time we've seen both sides of the equation shrink. Cash, that's an asset, goes down, and accounts payable, a liability, goes down by the exact same amount. And yep, the equation still holds.
It's the end of the month and business is good. Overnight provides some repair services and gets paid $2,200 in cash. Now this is a big one. The cash asset goes up, but this time it's not from a loan or an owner's investment. Nope, the business earned it. This increases the company's worth, so owner's equity goes up through a brand new account called retained earnings.
And finally, every business has costs. Overnight pays $1,400 for operating expenses, things like rent and utilities. This, of course, reduces their cash. And because it's a cost of doing business, it also reduces the company's net worth, which we see as a drop in retained earnings. And just like that, both sides of the equation shrink together, perfectly maintaining the balance.
And there you have it. We've just walked through an entire month of a brand new business, and every single step was captured perfectly by the balance sheet. So what's the big picture here? What does this all mean? So what are the huge takeaways here? First, always remember the balance sheet is a photo, not a movie. It's a snapshot of a single moment. Second, it's always telling the same three-part story: what a company owns, its assets, what it owes, its liabilities, and what it's really worth to its owners, the equity. And finally, that golden rule is unbreakable. That accounting equation is like the law of the financial universe. It always balances.
You see, understanding the balance sheet isn't just for accountants. It's for anyone who wants to speak the language of business. By learning how to read this snapshot of today, you gain the power to help write the story of tomorrow. So the only question left is, what are you going to build?